Interest rates, whether you're taking out a loan, saving for the future, or investing in the market, these rates play a critical role in your financial decisions. But here's the thing, interest rates are not static. They fluctuate, often in ways that can seem unpredictable. So why do these changes happen? Why do interest rates fluctuate? And what does that mean for you? Today, we're going to break down the key factors that cause interest rates to rise and fall, helping you understand the forces behind these numbers and how they impact your financial world. Welcome to WI, where we explore trends and unveil insights that define the future. What are interest rates? In simple terms, interest rates are the cost of borrowing money, typically expressed as a percentage of the amount borrowed, or the return on investment for savings or loans. They represent the price paid by a borrower to a lender for the use of money over a period of time. But unlike the price of everyday goods, interest rates are constantly on the move. Let's explore the key reasons behind these fluctuations. 1. Economic factors. Interest rates are deeply connected to the overall health of the economy. When the economy is growing rapidly, people and businesses tend to spend more. This increased spending can lead to higher demand for goods and services, which in turn can drive prices up, a phenomenon known as inflation. Central banks, like the Federal Reserve in the US, may raise interest rates to keep inflation in check. Higher rates make borrowing more expensive, which can cool off spending and help stabilize prices. On the other hand, during an economic downturn or recession, spending and investment typically decline. To combat this, central banks might lower interest rates to make borrowing cheaper and encourage spending. Lower rates can stimulate economic activity by making loans more affordable and saving less attractive, thus encouraging people to put their money to work in the economy. 2. Monetary policy. Central banks are the primary drivers of interest rates through their monetary policy decisions. These institutions adjust interest rates as part of their broader strategy to manage the economy. For example, if a central bank wants to curb high inflation, it might raise interest rates to reduce consumer spending and slow down the economy. Conversely, if the goal is to boost employment and economic growth, the central bank might lower interest rates to encourage borrowing and investment. But how does this work? Central banks set the benchmark interest rate, often called the federal funds rate in the US. This rate influences the rates that commercial banks charge each other for overnight loans, and ultimately affects the interest rates for everything from mortgages to credit cards. When the central bank raises the benchmark rate, borrowing becomes more expensive across the board. When it lowers the rate, borrowing costs decrease, stimulating economic activity. 3. Global events. Interest rates are also sensitive to what's happening on the global stage. Events like geopolitical tensions, trade wars, or global pandemics can create uncertainty in financial markets. When uncertainty is high, central banks may lower interest rates to support economic stability. For example, during the COVID-19 pandemic, central banks around the world slashed interest rates to near zero levels to mitigate the economic fallout. Global events can also affect interest rates through their impact on investor sentiment. For example, if a major economic power like China experiences a slowdown, it could lead to lower interest rates globally as central banks and investors adjust their expectations for economic growth. 4. Supply and demand for money. Just like any other commodity, the cost of money, reflected in interest rates, is influenced by supply and demand. When demand for loans is high, perhaps because businesses are looking to expand or consumers are buying homes, and the supply of available funds is limited, interest rates will rise. This is because lenders can charge more when money is in high demand. Conversely, when there's plenty of money to lend but fewer borrowers, interest rates tend to fall. This scenario might happen during a period of economic uncertainty when businesses and consumers are reluctant to take on new debt, leading to an oversupply of loanable funds. 5. Inflation expectations. Inflation expectations play a critical role in interest rate fluctuations. If lenders and investors expect inflation to rise in the future, they will demand higher interest rates today to compensate for the reduced purchasing power of the money they will be repaid with. For example, if you lend $1,000 today and inflation rises by 5% over the loan period, the $1,000 you get back won't be worth as much as when you lent it. To protect against this, lenders will charge a higher interest rate. On the other hand, if inflation is expected to be low or even negative, interest rates will generally be lower as well. In such environments, the purchasing power of money increases over time, reducing the need for high interest rates. 6. Government debt. Governments often borrow money by issuing bonds to finance their spending. The interest rates on these bonds, known as yields, can influence overall interest rates in the economy. When a government borrows heavily, it may push up interest rates as it competes with the private sector for funds. This is because lenders may demand higher returns when they see an increased risk in lending to a heavily indebted government. Moreover, if investors start to worry that a government might have trouble repaying its debt, they'll demand higher interest rates as compensation for the increased risk. On the flip side, if a government is seen as stable and low risk, interest rates on its bonds will be lower, which can help keep overall interest rates down. Interest rates fluctuate due to a complex interplay of economic conditions, central bank policies, global events, and market dynamics. By understanding these factors, you're not just gaining insight into a crucial aspect of the economy, you're equipping yourself to make more informed decisions, whether you're borrowing, investing, or planning your financial future. If you liked this video, make sure to click that subscribe button. We are here to give you an edge in the economic game by keeping you informed. Thank you for watching, and as always, seeing you in the next video.